Now, as we mentioned before, this week the Federal Reserve meeting to discuss raising those interest rates for the first time in years. Some leaders say raising the numbers will help with inflation, but how does that impact you? Reporter Joe St. George takes a look.
I already know what you're thinking. Another person on TV talking about interest rates. I get it. It's boring, but it impacts you. And if you give me just 90 seconds, I'll tell you why. With the clock ticking, let's start with the big meeting on Tuesday and Wednesday. That's when the Federal Reserve will discuss and likely decide on raising interest rates. The Federal Reserve is the government agency that sets rates for the country. When an increase happens, buying a house, getting a loan, your credit card balance, and even your savings account are impacted. Let's start with your credit card. The average credit card debt in the U.S. is around $5,500. The average interest rate is 16%. If interest rates are raised by around 1%, as is predicted, your monthly minimum payments will go up a few bucks, and if that's all you pay, the debt will be $300 to $400 more in the end. How about a car loan? A monthly payment on a $25,000 loan would only cost about $5 to $15 more. How about a house? A $400,000 mortgage would be around $200 more each month, and $70,000 more over the course of 30 years. That may impact someone's decision to buy, and it could cool off a red-hot housing market. There are some benefits to a higher interest rate. You will earn more from your savings account now. Not to mention, the reason the Federal Reserve is doing this is so inflation comes down. The thinking is that if things cost a bit more to borrow, people won't buy as much, forcing prices to stabilize. How'd I do on time? Okay, not bad. It really is important, though. We'll let you know what the Federal Reserve decides later this week. In Washington, I'm Joe St. George.